Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm joined today by Dan Kemp from Morningstar Investment Management. Hi Dan.
Hi Emma.
So we've just had an announcement from the Bank of England. They have cut rates to 0.25%. They've issued some QE and there's a new sort of funding for lending scheme. I thought we perhaps could go through the asset classes and see what it really means for investors. Starting with bonds.
Yes.
60 billion. Gilt purchase to come and a 10 billion corporate bond purchase as well in order to help boost asset classes.
Yes, so this is a heroic attempt by the Bank of England to make some of the most expensive asset classes in the world even more expensive. And all it's really going to do is bring forward future returns to the present. We hate to see investors pay too much for returns, and really we're just seeing an encouragement of that, unfortunately, from the bank this afternoon.
And this, of course, means that yields will drop. And we've heard from the Bank of England the forecast for inflation by the end of 2017, 2.5%. So it means for a lot of bond holders, negative real rate of return.
Well, that's exactly what we're expecting, and that's the worry, that you really are losing money, almost in nominal terms now, but certainly in real terms, by holding these assets. And so our argument would be that in many cases investors are paying far too much for the safety blanket of feeling they own a low-risk investment. In reality, risk is a function of price, and they need to be thinking about how much they're paying for these negative returns.
Does this mean bonds entirely are off the table, or just means that gilts are less attractive?
Well, gilts and investment-grade bonds are all pretty expensive, but it's important to say that they may have a place in the portfolio. They still act as a hedge to short-term volatility for equity holdings, which may look more attractive. So they still may have a place, but don't expect them to deliver a positive real return. You're not going to get that from bonds at the current price.
Let's have a look at equities then.
Sure.
FTSE 100 has gone up slightly, between 1 to 2%, led by Aviva, Standard Chartered, Kingfisher. So those financials and indeed house builders that have taken a bit of bashing since Brexit. What does this mean for equity returns?
Well, I think there's a general feeling of relief that the bank is doing something. The question is how efficacious the latest policy is going to be. And really, we would worry not a jot about what's happening over the next couple of days as this news sinks in, but really what's happening over the long term. And over the long term, the moves we've seen today are not going to make much of a difference to returns. There are some equity markets that look good value. We still think the UK looks pretty good value, and certainly elements of the European markets like financials look attractive, but generally asset prices, including equity prices across the globe, are still pretty high.
I think the most important thing to bear in mind is here at Morningstar, we're a real advocate of long-term investing. We're not speculators. Having said that, even over the long term, investors should expect more muted returns from their portfolio, shouldn't they? Although try to ignore all this noise.
Well, that's exactly right. And so the general level of returns has fallen as prices have risen. And so we're not going to get the sort of returns we would think of the next 10 years that you've had over the last 10 years. And so investors need to be thinking carefully about that. But at the same time, look for pockets of value. They will emerge. They're still there. And that can add to returns. But overall, we just need to see this latest effort by the Bank of England as just pulling forward future returns to today, which ultimately is unhelpful for the long-term investor.
Dan, thank you very much.
You're welcome.
This is Emma Wall from Morningstar. Thank you for watching.